Oh, good morning, everyone. Merry Christmas and prosperous New Year in advance. I'm your host, Yana Digborua from Transaction Traders. It's been a while, but I just have to drop this to appreciate you guys for being here all days long, for being here, especially for making the YouTube channel to 5,900 subscribers. So I believe in a few days it will hit 6,000 subscribers, and the YouTube channel, yeah, and then the Telegram, the Telegram group is going over 2,000. Sorry, over 1,000 subscribers, 1,024 members. God bless you. Of I just have to drop this for it's a special gift to you, from me to you. Yeah, I have to drop it to appreciate your presence here every day in my group, in my channel, on my social platforms. Just have to drop this to appreciate you. Please make good use of it. Very, very simple. A very simple of a thing. Yeah, very, very simple of a thing. I don't know any other this that could be as simple as this, or stress-free and very, very consistent. It's highly predictive, highly predictive. It's called the midnight opening profit every midnight of the day, Monday to Friday. Also happens on cryptos, but I've only done it on gold, silver, Nasdaq, US 30. Yeah. Um, we look at the charts to see how this work out. Please, before I go forward, I would like to tell you that an attention. Pay attention. Take note. Take your note and pen and write down this important information. Yeah, I would like to tell you that this presentation will come in two parts. The first part will be the introduction to the midnight opening profit. Yeah, the introduction to the midnight profit, what the setup is all about, then the consistency behind the setups. Yeah, then work through it on how it has been consistent on the level of consistency on different market instruments. Yeah, gold, silver, Nasdaq, 100, US start, cryptos, RTS of them. Yeah, and once again, I wish you Merry Christmas and do celebrate your success. Yeah, always count your blessing. Count your blessing. Name them one by one. Name them one by one. What you appreciate, you value, and what you value, you become. Yeah, it is real. What you appreciate, you value. What you value, you become. And what you become, you behold for long. Yeah, yeah. Don't take it lightly. Whatever you come by, whatever information you come by, never take it lightly. So let's go straight to the point. So that is my special gift to you, the midnight open profit. Yeah. This system, midnight open profit, yeah, it works It works on a, sorry, let me put it this way. It is based on a simple price action plus time. Yeah, you're going on the simple price action plus time. This man also always says something that whenever a pattern repeats, that means the markets makers or the market players are heavily trading on that pattern. So whenever it repeats, they're heavily trading on that pattern. So that is Jesse Livermore, a legend trader of all the time. Yeah, pattern repeat because human nature has not changed for thousands of years. It is real. So whenever you see a pattern that repeats now and then, take note. Major players in the market are focusing on that particular pattern or the direction. Yeah. It is based on the price, simple price action, which is a kind of a candlestick in combination with a pattern, a recursive pattern. Yeah. And that means it is time based. It is time based. So once it is that particular time you wake up and prepare yourself, set yourself ahead of it, it is time based. It's time based. Then it plays out every day of the market movements. So it is better played out on volatile instruments like gold, silver, Nasdaq 100, US 30, cryptos. So I'm looking at doing it also on the synthetic indices, probably like a V75, step index, etc. Yeah, please another then the time, the time, the time to see this playing out is between 0.100 a.m. and 200 hours a.m. So you can set your decision to my own stuff. Yeah, UTC Plus now on Trading View. On Trading View. So that is the timing on Trading View. So later on, you can see it as, you can also watch it playing very, very well. I highly predict on London Open, London Open, New York Open, London Plus. Yeah, which is between 7 a.m., 9 a.m. This between 13. Then from yeah. So these are the market key zones. We call this market key zones. Yeah. So the timing. Then this, if you have this is how it works. If this is it works in this way. This is the plan, the plan, how it works. Yeah, this is it. If you have a price that close on the previous day, that is because it closed higher on the previous day, close higher on the previous day. Mm, that's the closing price. Then the second day, market opens here, probably it goes up like this. Market opens there, probably it goes up like this. Mm. So sometimes there's usually a gap on Friday. If you are trading gold on Friday on weekends, there's usually a gap like this. But if there's no gap, if you get something like this on ordinary weekdays, you can get something like this. So then this one become the opening session. So that's what we call the opening price range. The opening price range, the opening price range is the distance between the previous day close and recent day open. This is this. That is the opening price range. The range, yeah, like this, right? We are going to make use of my own price gap here. price I showed to you in the last video I dropped that there's a difference between the smart money concept, fair value gap or imbalance, and my own price gap. So go and watch the video. So we're going to make use of it here. Yeah, is part of it. Yeah, I'm going to make use of it. So this is how this thing works. So if price gaps to open higher, this is the first day, this is the second day, probably this is Monday, and this is Tuesday, right? This is Monday. If this is Monday, it closes higher. Monday closes higher. Then we have this as Tuesday. Tuesday open here. We have this as Tuesday. So price opens and closes higher. Let's say it closes higher on Tuesday. Sorry, it moves up as a bullish candle on Tuesday. Then because you have the we are going to look at it from the one this the number 4, which is 100 a.m. to 2 a.m. So you are going to look at the direction of that candle, that particular 1 a.m. candle. Yeah, 1 a.m. candle. If this is 1 a.m., the market will open by 0000 hour. So this is 1 a.m. This is 1 a.m. It has come down. And this is 1 a.m. candle. 1 a.m. 1 a.m. candle. Yeah. And it end up like this. So you are going to look at something this. The direction of 1 a.m. to a.m. determines determines the next price action. So if this is 1 a.m., so that means 2 a.m. There's usually every day of the market, there's usually a move of at least on gold, minimum of 50 pips must be captured. I tell you this, you will not want to miss this opportunity. Minimum of 50 pips on gold, and silver is minimum of like maybe 100 or 80 pips. Yeah, it happens every day, Monday to Friday, every day. There's usually a move that is a bit volatile to move in a minimum of 50 pips on gold and silver. So that's why I say it is best placed, used. It is best used in a volatile market. Yeah. So that once it is 1 o'clock and you see the move, there are certain conditions must be there as a checklist. Yeah, you follow the trade, you buy or sell in that direction of the 1 hour, 1 o'clock or 2 o'clock candle. Yeah. So if this is this like this, now another point I want to add there again is that number 5. It is it is that is the price usually makes a reference point to the opening range, opening price range. So whenever market open and it gives you, and you are having your price range, right? The markets usually make reference once it moves from that open session, either up or downward. Price usually make a reference point, usually pulls back. Now then, oftentimes it pulls back into that opening price range. Yeah. So either to break it out or to reject it. Either to break it out or to reject it. Yeah. So if this is what I mean, if this is of the opening price level, right? This is the closing price of previous day. This is the opening price of recent day, right? Now, price usually does something. Is other price pulled back here, move back into this to come like this. Especially if this is a price gap. If this is a price gap means that between here and this, there's a gap that represented by a bullish candle throughout. There's no black candle in between this and this. This ended up as being a bullish candle, as a price gap. So price really pulled back into the opening range to retest. Yeah, to retest. So if it ends up being like this inside this price gap, let me proceed here like this. Price gap, price gap. Price gap usually the distance between the level of the previous day close and where the market opens. Yeah, that's price gap. That's price gap. So if you have this as a, let me change this to this. Yeah. So this is a bearish candle now coming down like this. Got to the price gap inside within that range, got to the price gap. It's 2 o'clock candle now. This 2 o'clock candle. So once you get this, that this is in a price, like all you are going to look at is that if this is a 1 o'clock, 1 o'clock candle. All you are going to look at is that you want to see this place either in a pin bar like this, it pulled back and close above the close above this as a pin bar. You want to see the place as a pin bar. Yeah. So once you see that, and then it is, so the assurance is that the possibility is that the price will continue to move in upward direction. Price going to move in upward direction. Price going to move in upward direction, going up like that. So this is a 1 o'clock candle. This is a 2 o'clock candle. So it came back again to retest, probably to retest this. This is 2 o'clock candle. 200 hour candle. This is the opening price, right? So Whenever market goes like that, so when it's coming to, so you'll have tapped almost about 50, minimum 50 pips here. So if you miss that opportunity, you will look, we are looking out for London. What will happen in London? If this is a price gap, you know for sure that once you have, you'll be checking, you want to see a pin bar within this price gap. This is a price gap. This can, this can is the price gap. This can is the price gap between this and this. After a week, the week of the candle doesn't matter. And the nature of the first and the third candle doesn't matter. Please go and check the video. Go and read, go and study the video very well. You want to post it like on my YouTube channel. It's on the YouTube channel. Well, so if you want to see this, as either a pin bar ended up being inside the this thing as a pin bar at 7 or 8 o'clock. London open. Yeah, like this. So once you see something like that, this is 7 or 8 o'clock. Let's say 8 o'clock AM. And so you will not want to miss this opportunity. You can go to, you get to see a level of entry that will be very low. So, but if the range of the pin bar, the wick is very short, like something like this. Yeah, something like this, something like this. So that means you are waiting for price, the next price to move and engulfs. Yeah. So price will continue to move in that direction, usually like that. Then he also in New York, you might have it also. Price normally make reference points to this price opening section. The London session may come to this like this, may form a pin bar like this. It depends. For a pin bar like this. If it does not fall, if it does not touch the opening price, that means the US session might likely go to touch the pull back into the opening price range. Yeah, like this might pull back into the then start going up again. Yeah, we show you examples. So note that's for buy. For sell, this is for sell. This is if this is the previous day close, right? Previous day close. Previous day close. That previous day close. Then this is the recent day opening, where market opens today. Yeah. So this is pricing. So you may have likely sometimes you may have it like this. If usually on the weekdays, you have it like this. So this is the price range, right? This is the price range. Price range. So this is a 0, our candle. So now you're going to look out for, you're going to see A bullish candle. A bullish candle. I'll pull back. Then with at 7 o'clock. Sorry, um, 1 o'clock. You check 1 o'clock candle. At this hour, 1 o'clock candle. We say pin bar. That means here will be your stop loss. Yeah, the top of the pin bar will be the week is your stop loss. Then you buy at the close of that pin bar. But here we must have confirmed that this place is what is a price gap. It's really a price gap. This candlestick is a price gap. Yeah, a price gap. Hmm. Sometimes it is like this. If you have a price gap in the past, something like this. If this is a price gap in the past, right? And then you have your opening range that falls on, if this is the opening range, like this. Yeah. So in the past, you may have something like this in the past. You have something like this in the past. That price before the opening, price has moved up like this. There's looking downward into this price gap, like this, like this, inside the price gap, right? So you now have something like this, right? Something like this. Yeah. Hmm? If this is the opening, this is the close. This is the opening. Why this is the close? We have it like this. Yeah. So this becomes the opening range, right? Now, and this is a price gap. A price gap. This is a price gap. This is a price gap, right? This is a price gap. This candlestick here. It's a price gap. It's a price gap. This candlestick here. So your reference point to this place will know that this place is likely going to go up. Yeah, likely go up. If probably you have this, you have a bullish candle that engulfs this at at 1 o'clock or 00 hour that engulfs this. If this is a 1 o'clock candle, right? And then the next one is a bullish candle. You surely know that here, because it's happening at a price gap, so you know that this will go up. From 1 o'clock, you must have captured your DC. Yeah, enough pips. As price touch falls into this price gap area. So and we have our 1 o'clock candle here. You start. So we try to listen. So you can take it to a lower time frame to see the other engulfment or the pin bar formation. Yeah. Like about a pin bar formation as well. To go back, to probably come back again. Let's make that to come back again. We want to pull back into this opening range like this. Right. So at 7 o'clock, you may have something like this. At 7 o'clock, move into this, a boom, to go up again. Right. So that is that for this. Let's quickly go through. This is good. This is good. This is good. This is a recent price action, right? Market closed at 24th of December, Tuesday, right? This was 2 days ago. This was Monday, 23rd of December. This is the close, right? Then this is the open. This is on Tuesday, 24th. This is 23rd. This is 24th candle. This is the open. So you can see that this is the 1 o'clock candle. Can you see that? This is 1 o'clock candle. It opens. You can see it. This is a price gap between the close and the opening candle. So there's a price gap here. It pulled this candlestick retested the price gap area and then ended up being a close above the opening price. So that gives us a condition that the market is going up because it has rejected this price gap. The market is going up. And if you watch carefully also from the past, this is also a price gap. Also a price gap. We're still acting here, pulling force for this price moving up. That's another clue. So, but this is the most recent price gap here, acting on this 1 o'clock candle. 1 o'clock candle. So from there, once immediately this is closed and you put up your this thing, probably go to your lower time frames. Let's see the how many pips here. It's almost about 78 or 79 pips. So you can see that price come back again. This is London, and because of this price gap, the market could not go higher than that. This is a price. This is a pin bar. This is a pin bar at London open. This is 8 o'clock. So London, then you have an engulfment. The next candle close below it, an engulfment. So you must have gotten this. Also from here, the gap, the opening price that caused this has been broken below. So your decision will be between this and this, and you sell it. Then the play that is coming to the opening price range. So you must have captured another. If you are smart enough, you must have captured another level of this here. It's almost 72. And because of this price gap also pulling me back upward. So price gap is a very, very powerful force here. It's a strong obstacle, major obstacle. And you see that. So from London to we have this as this is New York. New York also, because it closed below the opening price, pull back, finally closed below the this thing. You understand? Can you see so many tests of that opening price, finally closed below the closing price of Monday, and the price broke through it with a price gap. This is a price gap that took out the opening range again, the opening price range. So we are expecting, as we have this price gap, we're expecting price to do what? To move higher. So from, this is a 17 hour, that's a London close. on the close. So we are expecting price to pull back into this, and then you buy into it, scalp at 50. So market ended, the market closed at that hour on Xmas Eve. Yeah, so that's for this. So you can take it to like 5 minutes. You want to really enjoy a low risk trade at the from the opening range. Yeah, I see the gap. See the gap. Then this is the candlestick. Candlestick. You can see another gap here. You can use this gap. This is a gap. This gap. This is another gap that stays above or at a opening price range. So from there, you enter your buy. It's a confirmatory entry by 48. That it comes here, it gives you almost about 62 or 63 pips. Till around the 6 a.m. Right? And it came back again, was for fall on this this with a pin bar to the price gap. This should be 7 o'clock. Yeah, London open. And then with this price gap, we force on the price gap, then we have a pin bar and a government. So you stop loss here and a government at the close of this above this pin bar, that's an engulfment. Then it takes it out, then you buy. So you can imagine you bought here. Your stop loss is going to be something like 14 pips. And you target 1:2. That is 36. 36 pips captured there. So because it's still falling on that 1 hour price gap. So you should be very careful of that 1 hour price gap when you're taking your profit. And here also, we have a price gap here. Price moved downward. So this price is controlling. Price moved down into this pullback. So it finally move close below it. Then we have our this thing here. We have normal. So that is that for. Let's go to this the other one. So this is on Friday 20th of no, we have this is on Monday 23rd of December, which is weekend opening the period. This is a Monday 23rd. This is Friday candle. This is Friday close. Friday close here. Then we have this as opening. So we have a range. And price move down at 1 o'clock. Price move down. You can see the bull at almost about 60, almost about 70 pips into the body of this price gap, right? So, and it ended up being a pin bar. And then we have at 2 o'clock, thereabouts, 3 o'clock, after you must have made that 70 pips, then we have a rejection of this price at this price gap. And price close above the opening price. Then it pull back into it, close above it, at this price gap. Then you move another, you have another this in there, and the price move up to London session. This London session, because London session comes in a gap. So if falls in a gap, then you are going to see a reversal. Okay, that reversal comes down, then it pulls back. It came down, took out the opening range, and then market continued going downward. I see this place pull back into the opening range. So price always make a reference. Always make a reference point to the opening range. And this is on Friday, 20th of December. Friday, 20th of December, price. See a big move at 2 o'clock. Sorry, this is Thursday. Close, this is Friday opening. Then this creates the opening range. So you can see the direction here. Because of what? Market moves, took out this in here, a price gap, right? This is a price gap. But it took out the price gap close below the opening range. So you make a move there. You sell into that almost about 39 pips or whatever. So that's where you make probably you make small loss, a small loss there of about of about 23 pips, small loss. Then you have this 2 o'clock candle that moves and above this. So you are going to go into lower time frame to get this range. Yeah. So it pull almost about 136 pips. Hmm? Then there's a retest. There was a retest. There was a retest into the body of that candle, momentum candle, right? And the price continue moving higher into London section. London section fall into the price gap and came down, then it continued upward. That's so many times we usually have markets trying to pull back into the handle of that at 2 o'clock and continue moving in the original direction. It's not always, but at least I have it about 80% of all the time. Now this is that's Friday. This is another day. This is on Thursday, 19th of December. Eh? This is Wednesday close and Thursday opening. Can you see it? And price move from there. Can see big move. So markets usually move in every day in the middle of that night. See the first 1 o'clock and 2 o'clock candle. It's almost about 301 pips. Then moving into New York. So London continue with London pull back into this price gap of that 2 o'clock candle. Then it engulfs the last red candle here. So we have an engulfment here. Go to your lower time frame to see a pin bar here, so that you can buy into this pin bar engulfment. Then we make another entry point into the New York session. So get to the New York session, then you have a pin bar that falls into this price gap. And the government of that pin bar at the close of this day, you sell now. And price hits the opening price range, then it retests, pull up, came back into it, and then you have this on this. So enough, we will have just be disciplined. That don't be too greedy. Yeah. We have this is Wednesday, 18th of December. You can see this is Tuesday, Wednesday open, Tuesday. So we have a very, very narrow range here. Our price ended up being a close with a pin bar above at 0.0. And because here preceding, man, we have the price gap here. So we expect this as we have an engulfment here inside this price gap, we expect price to move up. Or be taking note of this. So that will be guiding you not to take the kind of profit you take. Yeah, but you still get almost a minimum of your 50 pips. So after this should be 3 o'clock candle. Yeah, 3 o'clock make a price gap that breaks below this goes back into the price gap and breaks below it. New York came in, or London, New York together came in close below the tight opening range. I can see price pulled back into it and then close below the opening range. So you sell your stop loss here and you you sell into that T CD, which move. This should be this should be article of the the FOMC of the last FOMC of 18th of December. Yeah, really put so much, put so much from New York. I've gotten this almost about 600 pips. Yeah. So that's that for. Then we have this as on the Tuesday. So this did not really because of this price gap here. So we only want to take a read. Then if you check, there's a pattern here, which we call this KML or an shoulder pattern. Then if was on the price gap, you will have used that as a guide too. And this is another one. It's another one. QML. This is a QML, right? You'll have used that as a guide. If you see it in other way around, in other this you can also use it. Let me check. Let me see here. No, it's not there. Well, yeah, so this will guide you that your major focus will be to sell. Yeah. Out here, this will give you a hint, more hint. They're here too, give you more hint. But this one still has more another session of this thing. This is Monday, this is Tuesday. So this is the range. And the price close above it engulfs it. To close above the range, then what happens? We have almost about a 73 pips. After that, you must get almost about 50 pips. Yeah. Then we have this on Monday, 16th of December. This is a Friday, then Monday. It's a range. Moving price range at full close below 1 o'clock, close below it. Then you have another move. That should be a price gap there. A price gap. Yeah, see it. A price gap. So that's therefore we see it. We'll come back as you get about more of different market instrument that this place ought to be. So God bless you. Stay behind. Stay behind. Stay behind.